I think that the most important things that have actually sort of qualified in the last decade per se has been the fact that we have allowed for more considerations to be added to the investment mosaic. And because of that, what I'm thinking is that tantamount historically was governance. And we definitely found that in many of the sort of investment philosophies and processes, whether it be value or growth across the entire landscape. Where I find that over the last decade, we've seen a commensurate increase in the understanding as well as the breadth and depth of what information you can bring to bear in a conversation around fundamental analysis. And because of that, I think that it's really important for many investment managers to have the ESG priorities pushed onto the investment team itself. Who else better is qualified to find and identify what are the financially material issues, risks, and/or opportunities longer term for a company, other than someone who's been stewarding capital in a sector for a decade or two. I think it depends on the sector, and I think it also depends on the geography. I think more importantly that we've actually qualified the idea that certain environmental issues, i.e. greenhouse gas emissions, climate change, vulnerability or risk, and biodiversity are starting to permeate into the board conversation. Investment management and investors in general have the opportunity and the leverage to take up that conversation with a much broader set of individuals at individual companies. On the fixed income side, I would say that that's true as well. But I would think the duration argument and definitely the discount rate appropriately for any environmental risk is important. What we've already seen through the pandemic and definitely through what we've gone through over the last year has been the flexibility and the opportunity set that is ESG issues, and more specifically E and S, can be flexible and malleable as we cycle through the cycles of the market. And with that, you need to understand that the priority stake of environmental or social issues can change over time. And we found that even more so being a value investor, where we're more exposed to, I would say, more intensive environmental focused sectors like industries, materials, and energy. I think that majority of, and probably more, everybody on this panel actually has access to the two largest ones that we found that from a fundamental perspective have probably the best coverage would be Sustainalytics and MSCI. To the extent that we've already discussed that they're very low correlated, I think that what it does is it frames kind of the fairway of issues. And as I said before, that's when the rubber meets the road of the analyst actually doing the heavy lifting and allowing for them to, it empowers them to give them arm them well enough to say that this is the key materiality issue, this is how we think about it, and this is what I'm going to engage on. To the side of like metrics and information, I think that we've talked about it before, but like the controversy issue, I think is a little weak in my mind. I think that it is important, but I think that many of the third-party data providers carry those controversies forward for too extended a time period, which I think puts them at fault. When you can have actual engagement with a company over the course of a year and know intra-year how they're progressing to improve that, where reflectively everything that's been said about them by third-party data providers is always hindsight being 2020 and potentially only on an annual review basis. So once again, it's a constant conversation. It's the open dialogue with companies. That's how we promote usage of understanding the issues, understanding situational awareness of the issues by third-party data, and then taking the active engagement, active ownership perspective for what David said, and really carrying that forward as a tool in our toolbox. I think that from being a value investor and being an active value investor, we have a significant portion of our benchmark exposed to more dirtier industries, right? And so considering that, we actually don't have the luxury, I would say, of actually divesting of energy. And so to the extent or materials or et cetera, but any carbon intensive sectors. So because of that, I think we do have to roll up our sleeves, get to work, and actually engage properly. On the active versus passive, I think Carlo, I believe, spoke to it before, is that it's the proof's in the pudding, and I apologize, but sort of garbage in, garbage out. So if you actually don't believe in the information that's coming from the third-party data source that's actually skewing and or aligning an index in a certain way to make it more ESG or sustainability favorable, then you're just getting into an index that you potentially don't really know how it's being constructed. So once again, I think if you want to have engagement, you want to show improvement. If anything, I do know about being active value is we get involved with some pretty hairy ESG issues, especially with all of our companies, because we have to make sure that we get our analysts on board with the idea that we can find improvement. And yes, as a worst case scenario, divestment is an option. But the passive versus active, if you want to have improvement, I think engagement is the only way, and you can do that through an active strategy, not passive.